Let's welcome in Hemant Kanawala, Head of Equity at Kotak Life Insurance. He's joining us from Mumbai. Thank you so much, Mr. Kanawala, for being with us on NDTV Profit. Now, after closing at 7-month lows, the markets seem to be stabilizing. Do you think most of the correction is done, or will future uncertainties drag the markets down lower?
See, market has been correcting on the back of two concerns. One is local, that we don't know what is the short-term impact of demonetization on the earnings of the company. And second was the sell-off in emerging markets as the trade was moving towards US economy. So there is uncertainty on both the still continues. So what we are observing is that normally there is some slackness of FI activity towards the year end, and because of that activity levels are low. So what we need to really observe is as we go into the new year, whether the selling by FI halts or it continues. So already we have seen some 7 to 8 weeks of continuous selling by FIs in the emerging markets, and normally after such a aggressive selling, it halts for the time in the near term. But we need to still watch it how it behaves in the new year before making that call. But some stability is always a good sign.
All right. Do you think the markets are factoring in the slowdown in the third and the fourth quarter on earnings because of demonetization? Are valuations hence looking attractive?
So, sense you get is that by and large investors believe that FY 17 earnings will be impacted in the near term. What is not clear is about FY 18 prospects. So as of now, investors, or if I believe market consensus as an indication of that, still believes that 15 to 20% earnings growth is possible. We don't have any clear visibility of that, and we'll need to see how the economy stabilizes in the March quarter. Also, we need to see what kind of impetus budget can give to the economy. We are hearing tax cuts being announced to boost the consumption. So various measures can be announced by the government to do that. So, March quarter will be critical to observe in terms of economic activity, and then we can take a call whether FY 18 will show us a good growth or not. Also remember that, because of GST implementation also, there can be some disruption in the period when it is implemented. So, as of now, still, government believes 1st April is a time when GST will be implemented. But if there is some delay because of some time taken to reach at the consensus with the states, and if it gets implemented by 1st July, then there can be some disruption in the initial part of the next year also.
Right. Now, you said that FIs have been selling for the last 6-7 weeks, and after, it is seen historically that after a period of selling, it could halt. Now, the consensus view is the dollar rally will continue and outflows from EM nations, including India, could go on. What would you watch out for from the new American President Donald Trump? After a point of time, the stronger dollar will start to hurt America. Some people saying it's as good as a 50 basis point hike, rate hike in the US. Could the dollar rally stem?
So I think one of the correlation we have been seeing is of the US interest rates and the dollar strengthening. So one factor to watch out will be whether the US interest rates stall. 3% yield is something markets are watching for. So if around January 20th, when Mr. Trump takes over as the US president, and if you see US interest rates also topping out, we may see dollar also topping out for the timing. So dollar strengthening may continue during the year because on the back of the policy announcements done by the government then. But what can happen is that you can see a temporary topping and some correction happening in the dollar in the meantime, which can bring some relief to the emerging markets. So I think important factor to watch out will be US 10-year treasury yields, whether they are showing some signs of, or at least temporary topping out. Because the overall belief is that nothing moves in a straight trend line. Once Mr. Trump takes over, he will make some announcements, and market may believe that things are not as fearful as we are fearing it today, and there might be some cool off in favor of emerging markets. Say one important factor to watch out for is also that globally another switch which is happening is from bonds to equities. So initially the money is moving to US equities, But eventually, if the investors believe that growth is coming, global growth is coming back, then even emerging market equities will be a destination they will be looking at. So that will also give some boost to the emerging market equities. So bonds remain a question mark, but equities, if the global growth is looking good, will come back. This is what we believe during 2017.
Right. So, do you think that in 2017 we will see good flows from FIIs?
See, these are always hard to estimate, but the belief is yes, certainly, because they have sold off in the last 2 months. Maybe that sell-off can continue for some time, but eventually we should see. What remains worry is more of even emerging market bonds, because money is moving out of bonds globally. If US interest rates are moving higher, the concern investors there is that even emerging market interest rates cannot remain low for long. So you will see firming up of interest rates even in the emerging markets. So that's where the money may move out of emerging market bond, but emerging market equities can certainly get more flows once investors get confidence into the global growth.
All right. Now, domestic flows this year have been very supportive. Do you think it will continue to be so in the coming year? Could retail investors throw in the towel if they continue to see losses in equities?
See, what the trend we are seeing for almost now 2 years is a change, is a correction in the extreme which had happened over the last 4-5 years. So what had happened that large part of savings at the individual level went into physical assets like real estate and gold, and financial assets like equities and bonds were under-owned. And even after whatever good amount of flows we have seen last 2 years, that ratio is still much lower compared to both our long-term averages as well as the averages seen in other emerging markets. So idea is that as if the inflation remains low and real interest rates are positive, normally financial assets are preferred in that environment. And that's where if this scenario continues, that inflation remains in the range of 4 to 5% and there is a real rate of interest of 1 to 1.5% over that, then money will flow into financial assets. It can be either bank deposits, equities or bonds, depending on individual's risk appetite. So equities will continue to get money even going forward if inflation remains low and we continue to offer a real rate of interest to the investors.
Right. Mr. Kanawala, you mentioned that there is a global switch from bonds into equities and that could benefit emerging markets. But even emerging market bonds could see outflows. How significant will that be for India? Because, there is a ceiling on how much foreign investors can buy on the government, Indian government bonds. And that, that ceiling gets filled up in no time. Could the bond outflow be a big worry for India if that does materialize? Will it really pressure the currency? Could it be made up for inflows into equities at all?
So, if you see last 3 months, FIs have sold close to $6 billion even in debt, which does not get discussed so much, but they have been really reasonably aggressive sellers on the debt side. And we have seen yields coming off from 6.2 to 6.5-ish range of lately. Now, good news is that Indian government is very committed to managing fiscal deficit. So next year borrowing program is likely to remain in the same range because your nominal growth will go up. So even if maintaining the slightly lower fiscal deficit, your borrowing will remain same. At the same point of time, because of the increased inflows to the insurance schemes as well as banks having deposits, there is a good amount of demand from those people. So overall, we don't see a scenario where reduced supply from the government, but increased demand from domestic side continues there also. So a reasonable amount of selling can be absorbed without much impact on the yields. But obviously, FIs come and sell much larger amount on the back of US concern, then it can happen. So again, if you see two things which have really done well for India in last 8 weeks, although equity have sold off, but both bond and our forex have been better than the other emerging markets. So other emerging markets have seen much more firming up of interest rates than India, and their currencies has also been under much pressure because traditionally in India we have preferred and FIs have preferred to come by equity route rather than debt, because you mentioned debt has a ceiling. So we are not we do not have too much money of FIs on the debt side. Equity is the preferred route, and so when the outflow happens, equity is self-correcting, whereas debt, the impact is felt much more on both the sides. That's where India is, well placed today, in spite of, having our FCNR redemption. Our currency has been among the better ones compared to other emerging markets. And our, interest rates also have held up, better. So our ability to manage FI outflows on both counts is, today much better than other emerging markets, which is a good news for us.
Right, but Mr. Kanawala, what I wanted to understand is that you're saying that we can manage the outflows in the debt side of the business. You said that emerging market interest rates could go up. So does that temper expectations of RBI rate cuts in the next year?
So RBI eventually will be governed by the inflation, because that is the cornerstone touchstone they will use to determine the interest rates. So because of that, so if the global growth is picking up and inflation expectation starts going up for RBI, then obviously that will reduce their ability to cut. As such, if you see today, then most economists believe that a 50 bips cut is possible over the course of next year. So we are close to the fag end of the cutting cycle. Whether more 50 bips can come or not is questionable, debatable. It may come, but that is not going to change the course much. What was required was a transmission of rate cuts by RBI, and which has happened during this quarter. So if that succeeds, that will help the economy and boost the borrowing by the whoever needs a fund. So RBI cuts are possible, because if inflation remains low and there is a outside chance that inflation may surprise RBI positively on the lower side. So RBI still believes that 5% is a possibility, and that's where they didn't cut the rate in the last policy. But eventually, if the CPI inflation goes to 4.5, 4, then their ability to cut rates will be more. So I think so. What we have to focus is on inflation. If India's inflation differential with the USA comes off, then we can sustain some more cuts, even when the USA rates are going up. So to answer you, it's a possibility. Yeah, they can cut rates.
Could the budget next year engineer a turnaround, perhaps jumpstart growth? What will the finance minister have to deliver to turn the sentiment around? Maybe more spending, but they also want to keep inflation under check. How will he manage this tightrope walk?
So first thing, as you put the last condition, if you want to keep inflation under control, first thing our finance ministry will have to focus is on the fiscal deficit. Because when the economy is facing a slowdown, it's possible that tax collections are somewhat sluggish. And that time, thinking by the government can be that we can sleep on fiscal deficit for a year and then, try to come back on the path next year. But that should be avoided. They should stick to the path, maybe not 3, but they can go to maybe 3.2. But some reduction compared to this year should definitely be achieved because that will help us keep inflation under control in the longer run. Second is to boost the economy. Some sort of tax incentives at the both individual and corporate level is a welcome. Particularly on the corporate side, if you see, government had announced that they want to move from 30 to 25 over the course of their 5-year tenure, but not much progress has been done on that side. So maybe they can give a boost. This becomes particularly relevant because today USA is talking of tax incentives for manufacturing in USA. Now, if USA tax rates goes down to as low as 15 and 20%, then we will have to be more competitive with them. Otherwise, we will find FDI difficult to get FDI into the country from an export perspective. So, corporate tax rate cut, and in the current scenario, even individual tax rate cut is a necessity. So, this will help us boost the consumption as well as investment. Also, some from a medium-term perspective, I think government should announce more allocation of funds towards housing sector, because that can give a boost at the very bottom level. It will take time to fructify, but I think so that's necessary, and it goes in line with the again the medium-term objective of the government to provide housing to all by 2022, and I think so we need much more incentives for that to happen going forward. So I think these are the two elements which can give a good support to the economy in short term and medium term. Only focus on infrastructure will continue, but we have to see what is the government's ability to spend that money, because a lot of funds get allocated, but unfortunately government finds it difficult to execute those projects at times on the infrastructure side. So more funds are always welcome on that side. We need more infrastructure, But if you are looking at it in terms of boosting economy in the near term, it may not materialize because of sometimes the time delays in executing those projects. So these are the three areas where I think the government will focus on going forward. If GST gets implemented from next year, then as such, indirect taxation will not much to be talked of because everything gets streamlined and will pass on to GST Council. So government will have little leeway to do on the indirect taxes. So direct taxation should be the focus of this budget, and that is where we believe government can make an impact in terms of giving boost to the economy.
All right, so you're expecting lower tax rates in the coming budget when it comes to direct taxes. But Mr. Kanawala, what would be the sectors that could benefit out of this budget? Would you play the consumption story, or would you play the infrastructure investment story? Because you said there could be some delays in execution. What would give you the bang for the buck faster?
See, we are having an excess capacity in the economy today. So finally, economic boost has to come via consumption, because unless capacities are utilized, there is no incentive for the companies to do new capex. So if you look at say cement and auto, both are having excess capacities today. So there is little incentive for someone to do large capex today. Some incremental capacities can keep on coming up, but both are not required by this country at this point of time. So we will have to give a boost to consumption. When I'm saying cement, if you give boost to housing, housing takes almost 60% of India's cement demand. So that will create need for more capacities in the future. But if that does not happen, then what will you create new investment for? So infrastructure is where we are lacking. So that is where individual government does. But because of the nature of the project, you need large parcels of land. You need huge water availability. So at times delays happen because of environmental issues. Government is trying their own bit to fast track it, but obviously there is a way of doing it, so you cannot fast track it beyond a point. But housing is at a very, very micro level. So if someone gets a fund to build a house, and when we talking of this fund is at a very, very small level. One who wants to construct a house of 5 lakh rupees. We are not talking of 50 lakhs and a crore of rupee. So he needs very less approval. You want to add a room to your current house, or add one more floor, you don't need much approvals, but it creates a lot of demand for cement and other home material improvement. It also requires a lot of services in terms of contractors and all kind of technicians. So that's a good boost to the economy at the very, very micro level. So that is what we believe, that overall consumption will be the sector which has to benefit for the economy to kickstart.
Right.
It cannot come from investment alone.
Are you saying that you're going to play the consumption story by looking at cement, home improvement, these kind of consumption themes? How long do you think will it take for a bounce back in other consumption themes like FMCG, consumer durables, autos? What would be your picks in the consumption space?
So we are positive on both automobiles and home improvement, which is basically a discretionary side. So after demonetization, there has been some concern that discretionary consumption will take a hit, which is taking hit. But what we believe that as currencies comes back to normal levels, which is already showing the signs, and government is committed to doing it by December end itself. So we are very close to that period. We've seen that transaction levels will improve and demand will come back. So we have not, and prices are also corrected in the meantime. So we are not really negative on it. Maybe it will take some time for growth visibility to come through, and stocks may underperform in that period. But eventually, the point I was trying to make, that if we want economy to revive, so one is that economy may not remain sluggish even in 2018. But if economy is to revive, that was the question we were debating, is then it has to come from consumption. That is the point we were trying to make, because investment will be done only when the current capacities are utilized, and most of the industries are having today excess capacity. If you look at RBI data, then at the aggregate level we will be operating at around 70% utilization. So we need utilization to improve at least 10 to 15% before companies think of large capex. So that is where the starting point is. So two things which will require which can take the economy up. One is public investments, which is the infrastructure investment done by the government. There is consumption. Third leg, which is showing some sign of improvement, is exports. So if global growth picks up, then it has been a big drag in FY15 and 16 both. But if you see, exports have been on a positive trajectory for last 2-3 months, And if this continues, then it can at least the negativity from exports can go down, and that can also help our economy from that side. So exports can be an additional leg which can start playing out if global growth stabilizes. So that is what we have to watch out for. But that is not in our hands. So beyond what we are asking what government can do is on the consumption and infrastructure side.
Mr. Kanawala, how would you play the export story? We have large exports from pharmaceutical and IT companies which are listed on the markets, but there are concerns. There are concerns about the US FDA action on some of the pharma names and about the entire IT business model changing for the leading IT names, and of course the uncertainty about what Trump is going to do. How would you play the export story?
So, see, you have to look at always the growth of any sector in relation to what the rest of the economy and market is offering. So, at some point of the earlier part of the year, we believed that the economy is on a fast track. So, growth in some of the other sectors was looking more exciting, and that's where IT was not preferred. But today, IT is continue to expect that it can show at the sector level around 10% revenue and earnings growth, particularly also helped by the rupee depreciation to some extent. Then since we are expecting a slowdown in the economy in FY17, then that growth does not look bad and valuations have corrected. So that way it may remain a good tactical trade. But from export perspective, maybe we will have to look at new emerging sectors like specialty chemicals or some select auto ancillaries which have been trying to make their presence felt in the exports market.
We'll leave it there, but Mr. Kanawala outlining for us a number of sectors that could benefit, and he would be watching out for the budget very closely. He expects some tax incentives on the direct tax side. He expects consumption, infrastructure, as well as exports to do well in the next years.